I've added 5 new positions in my portfolio. The portfolio, by the way, currently is underperforming the S&P 500. I'm up 1.25%, while the S&P 500 is up 3.24%. Now, of course, this journey is only a week long, so I'm not really bothered by that much. Plus, I still have close to 50% in cash. Now, for those that remember, last week I already revealed the couple of first companies I've added to that portfolio. 1, PayPal, 2, Alphabet, 3, Adobe. Then we've got Alibaba and Palo Alto Network. If you missed that episode, it's going to be in the top right corner. Now, in this episode, I do want to talk about the new addition to that portfolio. Some companies are only going to be here for the short term because I bought a dip or a crash, while the others I'm starting to build up a position for it to become a core holding in the portfolio. Now, I do want to make a couple of things clear. First of all, this portfolio is supposed to mimic what I'm doing in real life. This portfolio is meant as a diary, so I can clearly see I cannot edit any trades. You can even see the things that I add to my watch list. You cannot edit those, you cannot change anything. So it's really transparent. I will make lots of mistakes. I will have some wins as well, but it's all about learning and becoming a better investor, especially as a retail investor. This is me showing you what I'm doing before I buy or sell or trade anything. The research behind it, the reasoning behind it. Sometimes you might agree, sometimes you might disagree, and sometimes there is really not that much behind the reasoning. Sometimes it's just purely the stock is down quite a lot. I think it doesn't make sense. That's why I bought and that's why I sold. Just as easy as that. Now, that said, I do want to make something very clear here. I will not be buying or selling just for the sake of talking in a video. Some weeks I will have literally not that much to say, and so these videos will be boring. I know at first I said this is going to be a bi-weekly series. Now I'm doing this every week because I have something to tell you. There's still a lot of news out there now with earnings season, with a lot of things changing with regards to AI. So when I have things to say, I will make a video. I will not be making moves just for the sake of making moves and creating a video. That will never happen. This portfolio will also not have 100 stocks in it. I'll probably keep it between 10 and 15, with the top 5 being the core holdings. Then the rest will be either trade short-term or starter positions. That's it. Of course, feedback is always very welcome down in the comment section below. So thank you very much for all of the support from the first episode. The feedback has been amazing. And so let's start off with the company with a weight of 2.77% of the portfolio, and that company is called Snowflake. You definitely know what Snowflake is. I did cover this stock, its earnings report a couple of days ago. If you missed that, that's going to be in the top right corner. I added Snowflake at $182.33, just 15 shares. Why is that? Well, the stock basically crashed quite hard after it reported earnings. I thought it was an overreaction. I liked the quarter, tremendous growth as I explained in the video. Guidance was a bit weak, and also the CEO is leaving. Tremendous CEO, great guy. Some say he might or might not be the next Alphabet CEO in case Sundar is fired or leaves the company. These are just speculation right now, but to be honest, I could see it happening and I could see Alphabet soar after that news. But right now, I'm already up 2.42% on that position. This is purely a short-term trade. This is purely a buy the dip position for me. Once I'm satisfied, I'll be selling that position. I have no intentions of keeping Snowflake for the long term, although I do still think this is a tremendous company, just not one for this portfolio. For those that needed a small reminder, a quick reminder, this is a major overview of the last earnings report. So product revenue increased 33% year over year in Q4. For fiscal year 2024, revenue increased 38% year over year, so quite a high growth company. Net revenue retention rate at 131%. Total customers increased 22% year over year. Customers with a trailing 12 months product revenue greater than $1 million increased 39% year over year. So you're getting here a high growth company, of course, now with a new CEO, but it is someone that is pretty familiar with that company. Now, the main issue was guidance. This is guidance. They only give us guidance with regards to product revenue. They expect year-over-year growth of 22%. The market was expecting a bit more than that. Now, as I said, the stock is not cheap at all. Of course, it's cheaper right now than it was a couple of days ago. But as you can see, it has a market cap of $61.49 billion, forward PE of 190.8 times, EV to EBITDA 167 times, price to sales 17.8 times, and price to free cash flow 75.6 times. Definitely not cheap. It was never cheap. As you can see here, it is never a company that is trading at a cheap multiple. But sometimes you do get the opportunity to buy it at a less expensive price. Now, if we look at the graph, the main reason here, to be frank, why I opened that position is exactly because of this, the 200-day moving average sitting at $180. And as you can see, that was well respected. We've got some buying activity when it hit the 200-day moving average. Sometimes you have to play the technicals if it is a short-term position. This is exactly what I played here. Up next, company number 2 that I've added to the portfolio is a company that I'm still on the sidelines whether or not this is going to become a long-term holding or again a short-term one. For me, short-term means 6 to 12 months. Long-term means years and years. Trade meaning a couple of weeks. And this company is called Coupang, aka the South Korean Amazon. This one as well, we've covered the earnings report. That video will also be in the top right corner. With regards to Coupang, I bought 150 shares at $17.73. It is now 2.81% of the portfolio, and I'm already up 6.83% on that position. With regards to Coupang and its valuation, market cap of close to $34 billion, forward PE 65.5 times. Of course, as you can see, a huge jump after the earnings report. With regards to EV to EBITDA, 26.9 times, price to sales 1.2 times. Yes, as you can see, it's approximately the same as its 2-year mean here. Price to free cash flow, that's in the last 12 months, 19.4 times. Definitely not that expensive in my opinion. Even price to sales, just 1.2 times. I mean, quite remarkable, especially when you're going to see the current growth rates, which you get to see right here. Net revenue of $6.6 billion. That's up 23% year over year and 20% on the FX neutral basis. Gross profit increased 32%, so faster than net revenue. Operating cash flow of $2.7 billion and free cash flow of $1.8 billion for the full year. With regards to its WOW membership program, that's up 27% year over year to now 14 million paid members at the end of 2023. Now, Coupang, of course, is very, very focused in just South Korea. They want to be the dominant player, the big winner there, the basically Amazon without, let's say, the AWS. They are also growing quite fast in Taiwan, although that business is dragging a little bit on this company's profitability, but growing very, very fast. South Korea is a fast-growing market. Its e-commerce market is growing as well. Luxury market is very, very popular there, which makes the acquisition of Farfetch make sense a little bit more. Right now, still early days. We don't know what's going to happen with that, but it is an added value, especially for the price that this company has paid. So this is why I'm a bit on the sidelines here. Sidelines, maybe not, that's not the term to use, but anyways, could be a long-term holding, could be a short-term holding just for this year, remains to be seen, but Coupang is definitely a company that is flying under the radar. Valuation-wise, to me, seems quite okay. Of course, PE can be better, but right now this is a company that is growing quite fast across all metrics. Now, the stock itself, as you can see over the past couple of weeks, yes, it has gone up quite fast. RSI still not overbought, although higher than before, now at 62. We are also reaching an area where previously we got rejected, which is around $19 to $20 or so. So let's see what happens next. With regards to the moving averages, the 200-day one sits at 16.74, which is exactly where the stock was when it reported earnings. 50-day one at 15.44 and the 20-day one approximately the same, $15.39. So that's Coupang. Now, company number 3 is a company that I've talked about quite a lot on this channel for a long, long time. I'm probably one of the only ones that has been bullish on this company for a while. While if I had chosen its competitors, I would have probably been in a better place. And that company is called Intel. I bought 75 shares of Intel at $42.93. It is now 3.25% of the portfolio. Currently, total returns are 2%. Now, with regards to Intel, as I've said in the past, I'm playing the long game with regards to Intel. Yes, we've talked about AMD, we've talked about Nvidia, we've talked about Qualcomm, all great companies. But when I'm about to show you the valuation, you're clearly going to see that Intel is the cheapest of the bunch. Of course, all the others are growing much faster. I'm not even talking about Nvidia because they're in the league of their own, growing extremely fast, and valuation-wise, to be honest, not that expensive, maybe very expensive when you look at EV to sales. Yes, I think it's close to 18, 20 times or so. Not that cheap. But from a PE standpoint, I mean, we've seen that because the business is growing so fast, valuation still makes sense. But I agree, Intel has been lagging. Intel, before Pat rejoined the company, was a complete disaster. Everything they did was just to appease shareholders, which means just increasing the dividend and buying back more expensive shares. No innovation, not thinking about the future, data centers, AI, nothing like that. Pat came in, had a lot to do. Now, whether or not you believe in the comeback story, that's up to you, but currently they are well on track to come back and be back on top. I'm not saying they're going to be beating TSMC anytime soon. No, I mean, even they are expecting to be the number 2 foundry in 2030. Not the number 1, the number 2. It's going to take a while, but so far, so good. I'll compare Intel to AMD directly. I won't add Nvidia because I think Intel AMD is a bit more apples to apples here. First of all, with regards to Intel, a market cap of $185.27 billion. Forward PE 32.2 times compared to AMD's 55.6 times. Now, both of those are more expensive than their 5-year mean. With regards to EV to EBITDA, Intel at 13.1 times, AMD at 66.1 times. Price to sales, Intel sits at 3.2 times while AMD sits at 12.7 times. Price to free cash flow in the last 12 months, Intel currently, well, no price to free cash flow right now because of the whole restructuring and investment in their own business. AMD close to 300 times. And if we look at the PEG ratio, price to earnings to growth ratio, Intel 4.4, AMD 7.93. So here you can clearly see why I chose Intel. I chose Intel because I do believe in the comeback story. And if that works out, then my investment will for sure work out. I don't know when, it can take a couple of years. I'm sure, yes, if you hold AMD, you're very, very happy to what the stock has been doing for the last, year, 2, 3? I mean, actually, since Lisa Su came in. For what it's worth, for those that have been following the channel for quite a while, you know that I bought AMD at around $22, $24. Unfortunately, I sold in the $60 because I thought, hey, a 2.5x should be enough, right? Lesson learned, did the same with Nvidia. If your winners are winning, just let them keep winning. There's no reason to sell your winners. But going back to Intel, if they do manage to come back, if they do manage to create a great foundry business, which by the way, Microsoft is now going to use the foundry business. I believe its backlog is now over $15 billion. So the wheels are in motion. The wheels are in motion.
The wheels are in motion. Things are happening even as we speak. The wheels are in motion. The wheels are in motion.
Now, of course, there are still some risks attached to it, right? Execution needs to happen. Attracting bigger and bigger clients needs to happen as well. And yes, the CHIPS Act needs to happen, maybe CHIPS Act number 2 as well, because everything they're doing right now is very, very much capital intensive. They're going to invest a lot in the United States, in Europe. It costs a lot of money. If there is no government funding, then maybe that could lead them to not be on track to reach that leadership position. Could very well happen. And of course, guidance for next quarter wasn't the best one either. Some weakness there, maybe sandbagging, maybe not, remains to be seen. But I've added Intel for the long term. Now, currently, if we look at the stock, the reason why I've not added that much is because, well, it is a bit in no man's land right now. Very close to the 15, the 20-day moving average. The 200-day one sits a bit closer to $40. Maybe it will revisit that area. Remains to be seen. If it does, then that will become a area where I will be adding a bit more to that position. Then moving on to the next company I've added to that portfolio. This is going to become a core holding moving forward. No surprises there, right? That company is called Tesla. I currently hold 25 shares at $200.09. It is now 5% of the portfolio. Total return currently 1.23%. Of course, with Tesla, I don't really have to explain much since I do weekly videos of these companies. If you don't know that, maybe you should follow it. A weekly series where I basically recap everything that has happened with regards to the company during that week. I've been talking about Tesla for a long time. I've been a Tesla investor since 2019. So I've seen the highs, I've seen the lows, I've seen the great achievements, I've seen the controversies, etc., etc. And at $200, I said, let's open a position. Yes, I can still think that the stock might drop lower because 2024, with the guidance that we've got at the start of the year, wasn't the best of guidance. But with regards to Tesla, sentiment can change extremely fast. Of course, there's still this compensation package issue, the $6 billion fee issue, Elon Musk and X issue, still a lot to go through in 2024 and beyond. So I will be patient in building that position. Now, with regards to Tesla, for those that are interested, this is the current state of the company. A market cap of $645.37 billion, forward PE 63.3 times, of course, compared to its 5-year mean, much cheaper, but to some 63.3 times, still quite expensive, especially if you're going to look at the growth rates in just a second. EV to EBITDA 35.8 times, price to sales 5.8 times, price to free cash flow, that's in the last 12 months, 148.1 times, and then the PEG ratio here in the next 12 months, just under 3. Now, as I've just said, the PE is quite expensive right now because in fiscal year 2024, analysts are expecting this company to grow EPS by barely 2.54%. So yes, you are paying quite a premium for such low growth. But if you look at the estimates for the coming 2 fiscal years, it is expected to grow much faster than that. Fiscal year 2025, 37.18% growth, and then another 22.40% growth in fiscal year 2026. Of course, these numbers, these figures will be revised after each and every quarter. Despite it being a $600+ billion market cap company, still is quite volatile and its future is still, let's say, uncertain. Uncertain meaning it can become an extremely big business or it can become a big business. So that's Tesla for you. Up next, and that's the last company added to the portfolio this week. It's a pretty boring one, but there is a good reason why I added that company to the portfolio, and that company might be called Apple. So I added Apple at around $181.29. It's currently 5.32% of the portfolio. I'm already down close to 1%. No biggie. Now, of course, with Apple, I don't really expect that much growth ahead, right? This is not a company that is expected to grow 30-20% year over year, but it is a solid compounder, in my opinion, also a pretty stable company. Now, you know, I've been critical of Apple for quite a while now, but I've always said this is one of the best businesses on the planet. And in my opinion, the news of them not going after the electric car market, right? They're not going to make the Apple car was a good news for me, which means they're now going to be focused solely on their core portfolio of offerings, services, and products, and finally releasing what could be the AI iPhone. Of course, it will be a marketing thing for sure, but Apple controls its ecosystem, one of the best ecosystems out there. Apple controls all of its products. And so it is a no-brainer for them to release an AI assistant. Of course, there is Siri, but Siri is as dumb as they come. Maybe they've been working on something that makes more sense, that actually works, and that has access to the apps, the emails, the videos, the photos, everything you have on your phone, making your life way easier. Right? Could make a lot of sense. I've made this post on X with regards to NVIDIA's launch of Chat with RTX, which is basically an AI chatbot that runs on your PC. And so I said Apple and Google will eventually run the same on their devices, iOS and Android. Apple will market the next iPhone as the AI phone. Siri might actually turn into something smart now that the Apple Car is dead. It will have access to every chat, picture, video, and document on your phone. Don't sleep on this. We also know that one of the fastest growing segments for Apple right now is the services segment. It is the one with higher margins as well. We also know that Apple is buying back a ton and ton of shares, paying a small dividend as well. So right now, if you look at the dividend yield, it is just 0.53%. But if you mix that with the buybacks, you get a shareholder yield of 3.72%. Not too bad. Now, currently looking at valuations, yes, it is more expensive than its 5-year mean across the board. But this is also because Apple does experience some weakness right now with regards to, let's say, the upgrade cycle. There is weakness, maybe not in the iPhone market, even though the numbers didn't really show that much strength. There have been some report out of China that some stores are offering some promotions with regards to the iPhone, but there is weakness with regards to Macs, there are weakness with regards to tablets and wearables as well. So that's definitely something to keep an eye on. But again, I do think that the next wave, the next upgrade cycle with regards to marketing the whole thing as an AI play, that should boost top and bottom line. Plus the fact that services is growing fast, higher margins, they're going to do way more with regards to content, AI, machine learning, Vision Pro, AR, VR, all of that. Those are things that Apple is definitely now more focused on, now that it is official that the Apple Car is just dead and in the past, which by the way, they've burned around $10 billion doing so. So think of my position in Apple right now as a sort of second cash position that has a shareholder yield of over 3%. That might be going back into growth mode sooner rather than later. But one of the main reasons why I bought when I bought was because, again, of the 200-day moving average. Of course, right now, we are sitting a bit below it at 179.66 cents. The 200-day one sits at 180.79 cents. Okay, as you can see before here in 2023, we also went a bit below the 200-day moving average, but we didn't really stay there that long. Currently, sentiment is also not with Apple. You might also say that on a technical basis, this here at around $200 or so was a double top. Usually that's bearish. As you can see, back here in July 2023, RSI was overbought. We revisit those same levels and RSI is not overbought. This is usually a bearish sign, but I'm playing here a second cash position plus a technical one with the 200-day moving average. Of course, it can drop down lower, maybe revisit that level of rebound we've seen here back in October of 2023 at around $167 or so. Remains to be seen. But don't sleep on Apple, just like I said, don't sleep on Alphabet despite all the noise surrounding that company. I'll make another purely Alphabet focused video, I think tomorrow or so, because I do still think that there is a lot of noise, rightfully so as well. This company has effed up a lot in the last couple of weeks, months, and even last 2 years or so. But sometimes you just have to pull the trigger, just like with Meta. There is a big disconnect between reality and noise. So overall, to conclude, this is the current overview of the portfolio. 11 positions, including cash, still close to 50% in cash. So I do have time to build up positions. I do have time to open and close positions as well. Some of you are already asking in the comments, what about SoFi? What about Block? What about Palantir? What about this? What about that? Again, this is only the second week of me building that portfolio. I still have 50% in cash. Markets are close to or at all-time highs. So I'm taking my time. I have patience. Again, this is not a sprint. This is a marathon. Smart. Anyways, that's all I've got for you today. If you enjoy these types of episodes, do let me know down in the comments below. Of course, do like and subscribe. Leave some feedback in the comments. And as always, I'll see you all in the next one. Bye-bye.